David checked his 401k in April. He wished he hadn't. $165,000 in January, $153,450 in April, $11,550 gone. He stared at it for a long time. Then he did what most people do. He moved everything to cash. That decision will cost him $140,000. Not today, 23 years from now, when he realizes what compounding does to a mistake you made in a single afternoon. Here is exactly what happened. And here is exactly what it costs. First, what is actually going on? The S&P 500 is down roughly 7% in 2026. The Nasdaq is off 13% from its October peak. The Dow entered correction territory in a single session in March, dropped 800 points in one day. Behind those numbers, a US military conflict with Iran in February. Oil surged to $112 a barrel. The Strait of Hormuz under disruption risk. The 7 largest tech companies shed over $2 trillion in market cap from their all-time highs in 1 week. $870 billion gone in one day. $330 billion. And underneath all of it, the market was not cheap going into 2026. The Shiller-Cape ratio was sitting near 40. The historical average is 17. The market was priced for perfection. No room for a geopolitical shock. No room for slower AI returns. No room for a trade dispute. All three showed up at once. This is not a random event. It is a system that was stretched, encountering the reality it had been ignoring. Now the math. Because the math is the only thing that should be making this decision, not the headlines, not the feeling, not what your colleague said at lunch, the math. David has $165,000 in his 401k. The market is down 7%. His paper loss, $11,550. Paper. That word is doing everything. That loss does not exist until he sells. He sells. Here's what David thinks will happen. Market keeps falling. He avoids more losses. Things settle down. He gets back in. Here is what actually happens. Market falls another 10% after he exits. For a few weeks, he feels like a genius. Then the recovery starts. It does not announce itself. There is no headline that says, "Safe to re-enter now." There never is. The market moves before the feeling of safety arrives. It always does. By the time things feel calm enough, the index is already 20% above where David sold. He got back in higher than where he left. He locked in the loss. He missed the recovery. And across a compound curve that runs for 23 more years, that mistake does not cost him $11,550. It costs him $140,000. Let me show you exactly how. $165,000 left untouched. Historical average S&P 500 return, roughly 10% a year over long periods. At $67,780,000, David sold. Sat in cash 14 months. Re-entered 20% higher. At $67,640,000. The difference? $140,000. Not lost in fees, not lost in fraud. Not lost in one catastrophic decision. Lost by doing the safe thing at the wrong moment. On a compound curve that never forgave the interruption. Now the second mistake. Because David did not just move to cash, he watched the news. Energy stocks are up. Defense stocks are up. Exxon is up. Lockheed Martin is up. Every channel is covering it. So David rotates. He moves his cash into energy and defense. Here is the problem. The investors who made money on that trade bought before it was on every channel. That window closed. By the time it feels rational to rotate, it is already late. Historical data on this is consistent. Individual investors who chase sector momentum underperform buy and hold by an average of 1.5% per year, over 25 years on a $100,000 portfolio. That gap compounds to over $200,000 in lost retirement wealth. Not because rotating is irrational, because by the time it feels rational, it is already priced in. Here is what the full historical record says. Since 1950, the S&P 500 has declined 20% or more 13 times. Average decline in a true bear market, 32%. Average duration, 338 days. Here is the recovery side. Every time the S&P declined 10% or more since 1950, 1 year later, average return of 15%. 3 years later, 42%. 5 years later, 72%. That is not selective data. That is the complete record. The Great Depression, World War II, dot-com crash, 2008, 2020, every single one. $1 invested in the S&P 500 at the start of 1926 grew to approximately $20,000 by early 2026. That includes every crash along the way, every correction, every period that felt like the one that might be different. The people who lost permanently were the ones who converted paper losses into real ones.
So what do you actually do? 4 things. 1, calculate the real cost of selling, not the paper loss, the permanent one. Take your current balance. A 10% permanent loss at age 40 does not cost you 10% of your final balance. It costs you 10% of your starting capital compounded forward across 25 years. On $165,000, a 10% permanent loss of $16,500 costs approximately $54,000 in final retirement wealth. Write that number down. That is what doing something costs. 2, if you contribute every paycheck, keep contributing. A falling market means you are buying the same index at a lower price each pay period. If the market is down 15% from its peak, you are buying 17.6% more shares per dollar than you were at the top. When the market recovers, and the historical record is clear that it does, those cheaper shares recover with it. The person who paused contributions to wait and see missed that math entirely. This is not optimism, it is arithmetic. 3, separate your allocation from your emotion. If a 7% decline is keeping you up at night, you were not actually positioned for 100% equities. This crash revealed that. It did not create it. The move is rebalancing to what you can genuinely hold through a decline, not selling in response to one. Those are different decisions with different outcomes. 4, if you are thinking about withdrawing, run this number first. A $20,000 withdrawal at a 24% marginal rate plus the 10% early withdrawal penalty costs you $6,800 in immediate taxes. You receive $13,200, and you permanently remove $20,000 from a compound curve that at age 40 would have grown to roughly $65,000 by retirement. If you have 3 or more months of expenses in liquid savings, the retirement account should not be touched. David checked his 401k in April. He moved to cash. He rotated into energy. He felt like he was doing something. He was converting a paper loss into a permanent one across 23 years of compounding. That one afternoon cost him $140,000. The middle class does not lose ground in a market crash because the market crashed. It loses ground in the weeks after. When everyone is watching the same headlines, feeling the same thing, making the same decision at the same time. The crash is visible. The cost of reacting to it is invisible until you compound it forward. And by the time most people see that number, the decision has already been made. The question is not whether the market will recover. Historically, it does. The question is, who are you while it hasn't recovered yet?